Well, I'm setting up the YouTube now.
Take your time.
Well, I'm setting up the YouTube now.
Take your time. Did you mute me or no? You're muted. You're muted.
Yeah, we're live on YouTube, Joe. So
Okay. All right.
if you want to tweet out the link, you can do that, and then we can just start talking shop.
All right, cool. Yeah, I just tweeted it out.
All right, so just give me a second.
Maybe don't maximize your screen so we can both, I think, so we can both be up there on, like just maybe shrink the size. I don't know. I don't know if that helps because I'm looking at the YouTube thing and I don't see us both. Oh, it just goes back and forth. Okay.
Right.
No worries.
You want to give it a couple more minutes, Joe?
Yeah, if you want to wait for people to hop in, yeah, that's fine. I don't know. I don't know if that helps.
All right.
Oh, maybe I'm in full screen mode. Okay.
You know what?
Or we can just get started. Whatever.
Let's get started. Look, I just got back from the park from playing basketball, COVID free, by the way.
You got tested?
right before the game started, right before the street ball game started, I got tested. So big night today, right? Big day for earnings. Facebook, Amazon.
Yep.
What about them?
Let me pull up the chart here. Give me 1 second. Let me pull up. I guess we can just start with the market and then get into those if you want.
All right, so let's go. SPY.
Yeah. You want me to pull up my screen or?
Yeah, go ahead. Pull it up.
Okay. Give me 1 sec. Thanks everyone for hopping on. And one thing I found interesting, let's start first with the markets. One thing I found interesting about today is S&P, NASDAQ, this 21 EMA seems to be good support. And, the overall, my overall comments is like, you got to follow what the big institutions are doing. They're not selling. There's very little distribution. And even though we might not be moving higher, we're at least consolidating and going through, some sector rotation. So this green line here is the 21 EMA, and we held that. This is a daily chart of the NASDAQ composite. When I pull up the S&P 500, you can see the same thing. We gapped down today, and we just held that same line. And overall, the markets are consolidating well, and the big institutions, there's just very little selling. And it's important to follow what the big institutions are doing because they control the markets. And as long as they're not selling, it doesn't mean we have to go higher, but at least this has been a pretty decent, sideways consolidation, as you can see here in the S&P for the past 6 or 7 weeks. And on the NASDAQ, it's been about 3 weeks of just of sort of we're stuck in this range here, but we're at least the positive thing is we're holding key support levels.
Right. And the 21-day, correct me if I'm wrong, matters because it has mattered. It's been
Yeah,
support since April. So
some people use the 20, 21, 21 EMA simple. From what I understand, the studies just show in good uptrends, strong stocks and strong markets hold the 21 EMA, the studies show. And I know they're going to be close. Some people use 20, 21, 22. The reason that number comes up is because that's roughly how many trading days are in the month. But the studies show right around those levels that strong stocks and strong markets hold those levels. I could pull up, like one of the, just as an example, like a DocuSign, even though it broke out of this original base, you can see all the way up. It's just held this 21 day. And even on this recent pullback, it's just held this level really, really well. So it's just nice as a first level of support in strong markets to hold. Then the next one, in my view, would be the 50 day.
right. So let me ask you this. What do you think happens when we finally break that 21 day, which we've been touching for the last couple of times in the NASDAQ? Quick flush?
I'll be hiding under my bed. I don't know. I mean, I'm torn with sentiment because right now we're consolidating. So a move down, it's a great question. A move down to the 50 day would be, 5%, which in the grand scheme of things, let's say it did happen from this sort of, 10-8 down to here, it's normal in uptrends to have, 5, 7, 8 to 10% pullbacks. That's actually perfectly normal. And in the S&P, because I know a lot of people like to follow this one a little bit better. I mean, even if we were to have like a pullback to the 50 day, I just think that that's overall in the grand scheme of things, that would be fine. I'd be concerned if you saw a cluster of distribution days and if we really broke below these levels. But so far the trend's been very, very strong.
All right, so we've been going sideways, right, in the S&P 500 and also the NASDAQ for the most part for the last 3 weeks. Talk to me about individual names. Are they going sideways, or are we seeing some, are they gaining some traction as well?
Yeah, and I was also going to mention the Russell as well.
Go ahead.
What, under 1,000, 966 over a 50% move off of the lows. And again, it just had a normal, it happened pretty quickly in about 3 days. I think you pointed this out the last time we did a video. It was a quick, 14, 15% correction or so in a few days. And since then, we're going sideways. Now, what I'm noticing with some of the leaders, we can pull up some of the ones that reported today. They're just same thing. They're holding these levels. Amazon's the market. Amazon's one of the biggest liquid leaders out there. And even when it broke out of this big base, on the weekly chart, it was this big base originally at 2,200 and it ran up and it just continues to run up and just pulls back. And it's just normal price action. The more you study charts, you realize that this is pretty normal. I think of, Microsoft, Apple, just some of the FANG names or whatever. Same thing, broke out of the space and it just moves up and just has a normal pullback. And these are just consolidating well. And as you mentioned, all the big four, I was thinking maybe two would report good, two would be a miss or whatever, but it's amazing that all four of them had, had pretty strong numbers after the close.
I don't remember the last time where I seen the market, the QQQs of the NASDAQ ride that 20 day for such a long time. And you can see that every time it touches that level, it just bounces. And not only the NASDAQ, but Apple and Amazon. I can't remember the last time I saw that.
The last time I think I remember was after QE2. Let me go back to this chart really quick and show you the fall of two. At least for me, the time I can remember this being this strong. I'm just pulling up a chart here of this is a chart of 2010. Okay, just for people who are watching, just to give you perspective, this was a flash crash May of 2010. And then right here, September 1st, 2010, Ben Bernanke announced QE2. So this was after the housing crisis, financial crisis, TARP, TALF, all the QE they did. And then they realized we got to do more. So the analogy is more liquidity coming into the system. But this is the last time, and it's a great point you make. This is the last time I can remember after they announced QE2 and they said, we need more stimulus, whether we agree with it or not, it's not the point. The market also held this thing pretty amazing, had one normal pullback, but this was just 6 months of holding that. from the September end of 2010 into like first couple of months of 2011.
And that was more one of the classic bottoms where we went sideways for a few months.
Yes. This was a normal, not exactly 20%, but this was a 3 to 4 month corrective bear market type of action where stocks put in normal bases and just was like you said, a normal whatever.
Normal.
It was like a 15 to 20% correction in the summer.
And then sideways action to allow things to set up. Unlike now where we're seeing these V bottoms where it's like they sell them and they realize they made a mistake and they're all buying back at the same time.
Well, yeah, like in this example, if this was now, I mean, they would go like this, and then we've just shot up like that.
Right.
Where what it did this time was carve out a, sort of like a U bottom instead of a V. For people to understand the V bottom, it's a letter V where you just go down and straight up. Where you go down and form more of a letter U, and this is what normally would happen, but
or a W for win,
yeah,
M for murder.
Exactly.
Now, guys, on YouTube and also if you're in a Zoom meeting, I implore you guys to ask questions. The more, the better. The more you're going to get out of this. All right, so Joe, so we did the composite, we did the S&P 500. Now, let's go with the names that reported in the after hours.
Yeah, I mean, just looking at this, I think Market Smith has updated just so you can see. I mean, Amazon.
What's the reaction? Let's talk about the reaction first.
Let me see. I'm going to go here and show extended hours pricing so you can see. It's showing where they're trading. So, I mean, this is insane. I think 90% of businesses never get to $1 million in revenue, and Amazon just did 89 billion in a quarter. I mean, we knew everyone's at home and e-commerce is shifting to Amazon, but this is insane. This is for a $1.5 trillion market cap company to grow their revenues at 40%. I mean, no one in their right mind would ever imagine this. And they grew their earnings at almost 100%. This is, I mean, I guess that's why people want to break it up because it's too big and it's not just obviously retail, it's AWS because more people working from home, more, need for cloud.
Would that change anything? Let's say, for example, they break it up. We're going to stop buying stuff from Amazon.
I don't know. I mean, this is a different like regulatory with like AT&T and breaking up into all the bells and stuff like that. I don't think it'll ever, I mean, it could happen. I don't think it's going to happen anytime soon. Because that's why they're all on Capitol Hill, because these companies are getting too big and people are concerned. But anyways, we're not going to get into that stuff. But you're right. I don't think it would stop anyone from ordering. And I think it would just take a lot of effort to break these down. It wouldn't happen overnight is my point. But right. When you look at that, that's a monster. When you look at Apple, I mean, I know the economy's, everyone's struggling. Is maybe everyone took stimulus checks and bought phones, and bought iPhones. I mean, it's amazing because again, this is an over, $1.5 trillion market cap company to grow their. I mean, this isn't like doing 20 million and 25 million. This is 60 billion in sales. They grew their sales at an 11% clip and their earnings in the high teens. That is effing insane. I don't know what else to say. I mean, it's absolutely amazing. Google, we'll go through these really quick. Google did have sort of a downtick because Google and Facebook are a little bit more ad centric, even though Google's in a million other businesses, but that's the majority of their revenues. It did have a downtick, but I guess their guidance was decent. And then Facebook, same thing. It's just amazing. They are just a cash machine because even though some of these advertisers saying, okay, we're going to stop for whatever political reasons off of Facebook and Google. Where else are you going to go? Where else are you going to go where all the eyeballs are? So that's just temporary and it doesn't affect their business.
All right. So they came out with great numbers. The stocks reacted well. I don't own them. What do you do here?
I mean, they're widely held, so hopefully some people already own them or through mutual funds or through the SPY or through the Q. I mean, if you have any retirement, I'm sure people own a piece of them because I think collectively, whatever the numbers were, 15 to 25% of the market reported.
What about Robinhood? Robinhood Joe doesn't own these things. And
no, I would do excited. I would do a screen for bankrupt stocks if you're on Robinhood. And then that'll give you some ideas for tomorrow. I think there's a screener in FinBiz.
What I'm saying is, I'm trying to ask you these hard questions that someone will ask. Would you Will you buy them here? They gapped up. Will you buy them after this gap up? What are you doing? You're buying,
I
selling,
I
or
think
holding?
I think you got. I mean, hopefully, if you're, I mean, it's a great question. I wouldn't chase them. I wouldn't chase them. They're great numbers. Let them relax a little bit. They're not small cap where I think they're just like some of the smaller cap names can gap and go, and you can trade those. I think even if you look at Amazon, what it did last quarter, and it had some great numbers here and gapped up. It just still goes sideways, even if it goes a little bit higher. Just I wouldn't be chasing these names. I mean, Facebook had great numbers before, and it gapped up here, and then even though it went a little bit higher, just wait for them to. I wouldn't be chasing them. That's my. I mean, what do you think? That's my personal opinion.
Oh, I never chase.
No, I know you're very disciplined with that.
I think the last time I saw a breakaway gap was back in 1999. But no, I think, look, I think that I much rather, let's say, for example, something gaps up like an Amazon and it's trading at 32.05, right? I much rather see the stock go sideways for 5 to 6, 10 days and buy it at the same price than buy it here, after a gap up, after a huge gap up
Agree.
for some great numbers. And the fact of the matter is, I think now after, you mentioned the 21 EMA, if you wanted to buy it, that's pretty much your short-term line in the sand. Is that 21 EMA? There's
Yeah,
only
I think with these mega caps, you got to be patient, and eventually it's not going to be tomorrow. It might not be next week, but things slow down. August, September tend to be traditionally 2 tough months. Even if they don't, come down and correct too hard, just give them time for the moving averages to catch up and to consolidate.
right. Here's a question on YouTube. I'm interested to see your responses from your base on your vast experiences. What do you make of some of these companies which guide revenues way above consensus but below when it comes to their earnings per share? So revenues up, earnings per share a lot lower.
It's a great question. I mean, I think some of these companies that are building infrastructure, whether it's some of the software names and so forth, they're spending their money on R&D, a lot of them. So you'll see this. I'm trying to think of an example like ServiceNow. I know they just had earnings. This is an example of what you see here on the left here is, it took them a while. This is a mature company now, but you can see -7 cents. It was no earnings, 40 cents. They're spending money building the infrastructure and building their whole company and establishing everything with their customers and licensing. And then once that's built, that's why software is such a great business. Then the margins open up and you can see they go from earning no money to earning over $5 projected next year, and now they're over an 80 billion market cap. So I think right now analysts forgive some of these companies that are newer, as ServiceNow was 5-10 years ago, that are newer now as they're building their businesses to have less earnings, and then eventually they know the earnings will come down the road. But a lot of these companies are cash flow positive. They're just spending their money on R&D, infrastructure, or whatever they're spending on to build their business.
And I think also, Joe, that what matters the most is the reaction.
Yeah.
And whoever has the ability to move these stocks, they probably have more information than you and I, because they have analysts out there in the street, they have analysts out there meeting these companies, so they're probably seeing something that we don't see. So you got to go
Yeah.
with the reaction, in my opinion.
The person said an example is Teledoc, the person who asked the question, and that's why I pulled it up, where same thing. It's been negative for a while, but with projections. Look, eventually you do have to show some sort of a profit. Remember, Amazon forever was not showing a profit, and eventually the floodgates open. So, some of these are trading on turning a profit in, 2-3 years from now. So I'm glad they pulled up Teledoc as an example, but you make a great point. The reaction is the analysts or the people investing in this, the institutions know the bigger story and are playing this probably for something down the road, is just my guess.
Okay. What major value leaders or other sectors do you see having good entries at this time?
That's a great question. I did notice, let me pull up I did notice some home builders on my screens, because most of my screens have been all software, biotech, semiconductors, all tech related, medical products. And I have noticed, this is one example. This is ITB. There's also XHB, are the two main, sorry, I typed it in wrong. XHB are the two main home builder ETFs. And I've noticed that there's a lot of these showing up on my screens as far as like value sector rotation.
All right, so let's talk about. Let's just.
If you want to share your screen and pull up whatever, you go right ahead.
No, I'm
You're
fine
good
now. I'm still like thinking about the game. Just give me a second.
That's funny. How many points did you score?
Too many.
Too many.
Yeah.
They triple teamed you, I'm sure.
No, they just gave me the ball. But let me ask you this. Let's just make this a little bit more exciting. Give us something that you usually don't do. But I want some predictions, Joe.
Oh no.
What do you think is going to happen? We are going into August, which is normally a seasonally weak, whatever first couple of weeks. So they're trying to front run the month of September. Give us a prediction.
Prediction. I mean, I hate predictions, but
let me do it. But go ahead.
Of course, you're going to hold it. This is going to be recorded and left on YouTube forever. All right, look, on the S&P, this is more of an analysis. We come off of the lows and we're in a range 2760 to 2950, roughly this 200-point range. What's amazing is when stocks or markets make a move and barely give anything back on light volume, that is a positive sign. So we launched off of the lows, 500, 600, 700 points on the S&P, but look down below here. This red line is the 50-day moving average of volume. That entire consolidation was showing us that the institutions were barely selling stock after the move. Now, this is where, you have to just shut out the news and shut out your opinions. In my opinion, and your opinion, everyone's opinions are usually wrong, and just do your best to analyze what's going on. So it just showed us that we bounced and they weren't selling anything. Now we break out of that range and now we establish a new range. 32, 33, which is roughly even on the year. And the lows was this prior low, call it 29.50 or 60. Now, you want me to directly answer your question? I think that it's constructive that we're holding this range. And we're also, after the end of the quarter came out, there's been just very little selling. And I think we eventually resume with sector rotation and eventually head back towards highs. Will there be bumps, shakeouts, corrections along the way? Absolutely. But I'm basing this on, again, very little selling by the institutions.
Right. And you are quick to change your mind based on price action.
Absolutely. If you saw some unforeseen event happen in the next month and a series of selling and leaders breaking down and a lot of distribution, by distribution, I'm looking down here, there's just, very little sell volume. If that built up, that is a huge, that's why I always tweet out Stanley Druckenmiller, like paraphrasing what he says one of his greatest assets is his ability to change his mind quickly if he needs to. And that's very, very key for everybody.
Let's touch on sentiment. Because I think we're seeing like two extremes, which is pretty, we're seeing an extreme where you see that the AAI numbers was just it's a survey, but that's been helping the bulls. But then you see the Robinhood guys, and that's like a little bit on the other side. And then you see the put to core ratio. Are things not working the way they were before as far as sentiment is concerned?
That's a great question. Your guess is as good as mine. They normally correlate together, meaning price leads to sentiment. We go down, people get bearish. We go up, people get bullish. That's usually how it goes, human nature. It is mixed right now. Like NAIM, they're at 97% invested. Those are active managers like you and me. They survey how much are you involved in the markets between 0 to 100. It's usually about 70.
I put 150 trying to jinx the market.
I mean, it's like came in at 96, 97 2 weeks in a row. Is it the only sentiment measure? No, but it's showing that active managers, it's well above their average. So they're loaded in. AAII is showing everybody's bearish. That's the survey. And you're right. There could be a difference between what people say and what people do. And then with the call buying, I mean, people are buying equity calls like Steph Curry shooting 3-pointers from half court. It's like every day we're down, we're up. It doesn't matter. They're just buying calls and calls and calls. So I am just as confused on sentiment
And,
as anyone else.
and then you had the Kodaks, right? Kodak goes from whatever it is from, I don't know, 2 to
They went from
50.
what? From I didn't even know they were still a company. They went from cameras to having a cure for the coronavirus or drug doing drugs now.
It's amazing, right?
Generic drug maker. I don't get it. I don't get it. You're right. There's some definite pockets of froth, but
It
at the
doesn't
end,
matter now. It just doesn't matter right now.
I even stopped looking at the equity
Right.
put to call. I love looking at it. You get a series of a lot of call buying over a week or two, and then the market drops. I just don't even. It's like just throw it out the window
The problem
because.
is what
Go
what
ahead.
ends
Go
up
ahead.
happening, Joe, is that you're out there looking for something to put your foot on the brake.
Yeah.
You're searching and searching and searching, and you find stuff, but it's not working.
I think the moral of this is price action first and sentiment second. And price action is going to override because there's several sentiment surveys, there's several indicators, there's AAII, there's NAIM, there's also the Investors Intelligence, CNN for Agreed. We can go on forever. Put to call ratios, Citibank. I could list 10 of them right now that off the top of my head. However, they're mixed right now. So that should be a secondary measure to the price action of stocks.
Now, Joe, look, all right, so we know that you manage money, right? But you also have an educational product, right?
Yeah.
So you are interacting with a lot of people, right?
Yes.
In this educational place where you're giving out recommendations, you're giving out market videos. Can you like what is it like the number one thing after being in this educational product that you run and you interact with a lot of people? What is the one thing that you come across often that people are asking the same questions? Or if you wanted to make a suggestions to anyone who's getting started, what would that be based on what you're seeing in your educational product?
Um, that's a great question. This is, I would say position size is one of the right off the top of my head.
And that's something no one that's like one of the most important things that's not widely spoken about. You don't have many books on that, by the way.
No, no. And you
Very
know
few.
what? And I'm sure you get this too with your product is you find a lot of questions. I hate to be so flippant and just the answer is it depends. I mean, it's like I hate to avoid the answer. There's no right or wrong answer with a lot of these questions. I would say one of the most common questions I get over emails or whatever is position size. Maybe you could talk a little bit about that because my first instinct or first response is it just really depends because it just depends on your risk tolerance. If you're trading for yourself, you're trading for others, and there's just a lot of different factors. But if you want to talk a bit about it some more, and then we can, I can bounce back from that one.
You're gonna dodge the question?
I mean, I don't want this to be an interview. I want you to I mean, go ahead. I mean, you're the master with the position size stuff. I mean,
No,
with the
I think
risk.
like you said, it's completely relative, right? It's relative as far as that, if you have a different risk parameters or you can take on more risk than someone else, it's different for everyone else. But I feel like a lot of people, a lot of retail investors, they're normally in two extremes. The one extreme is that they go all in into one stock, or they spread themselves out in 100 stocks. And
Yes.
once they go all in one stock, if it works out, that's great. If it doesn't work out, then they got issues. And then once they spread themselves out in 300 stocks, then they just don't perform as much as they want to perform. And just the other day, I was going through some stocks. There are a lot of stocks that have done nothing for a long time. I mean, even
Yeah.
if you punch up something like Facebook, Facebook traded between 220 and 140 from 2018 till just recently.
Let's look at the weekly chart. Yeah. I mean, you're talking about not going anywhere for a while.
Right. I mean, so So one thing is position size. My recommendation is that uh, you got to figure out. I always tell people, number one, anything can work. When someone's asking me about a stock, anything can work. What you need is a plan. You need a buy stop. You need a sell stop. And what my definition of the edge is, something that has a higher probability than a random outcome. So if I'm looking at a chart, if I see, for example, a specific pattern, that pattern has to be one that I'm willing to take 1,000 times,
Yep.
right? Because you got to take them 1,000 times because you don't know the sequence of wins and losses, and you just got to take the trades and let the numbers play out. And in order for you to do that, you have to have a constant position size. And my recommendation is always risk the same until you get, for example, until you get a series of trades under your tool belt that you can go back and say, look, uh, these over here that really outperform, they had three things that were in common that were not in common with the other ones. And then in the future setups, you can raise your risk on certain specific setups.
Yeah.
You have those or no?
Yeah, I mean, there's certain. I mean, it depends on. I mean, for example, you made two great points here. Where when you talk about the first one about stocks that haven't gone anywhere for a while, okay. So I even said, and I tweeted this out around early to mid-April. Nvidia, Amazon, and Netflix hadn't gone anywhere for a while. I guess you could add Facebook to that one as well. And by not gone anywhere, meaning from the top in October high of 2018, they hadn't gone anywhere for a couple of years. And when I see something like that that's turning around and the earnings are turning around, I might, coming out of a big base, I might take a bigger position if these things, whatever, the bigger the base, the higher the space, or whatever the expression is, because it hasn't gone anywhere for a while. And now you're starting a first stage move. If it's a shorter pattern, I might take a smaller position just because, so that is a factor. It's also a factor of where we are in the markets, as far as coming out of a bigger correction. Like I was talking about Amazon, same thing. These were all the same patterns where they hadn't gone anywhere for 2 years. And when they finally break out, this could be a move for a year or two before a meaningful correction comes in, potentially.
Right. Isn't that amazing that we're talking about Amazon not moving for 2 years? It doesn't seem that way based on the news cycle and based on how much we talk about FANG. It's amazing.
Yeah, it's recency bias because just recently Amazon, but people forget it's stuck around 1,600, 1,700 for like a long time. But then once it broke 2,000, it just went right to 2,400, then right to 3,000. So
Right.
it's recency bias, but we all have short-term memory, and we forget that that it went sideways for a long time. The second great point you made about is, people with position size, they tend to be all in one stock or have 100 or 200 stocks. I know William O'Neill talks about perfect diversification being about 20 stocks. I think that's solid enough, because once you get into too many names, then you might as well just own the S&P. Because if you have 100, 200 names, you might as well just own the S&P. What's the point of owning so many stocks? If you really want to outperform, the true way to do that is with a concentrated portfolio. However, this is what I mean by everyone's answer is different. Someone's concentrated portfolio could be 3 stocks, someone could be 30. That's where you have to make those decisions based on your own risk tolerance.
Right. People can tell you what it is, but it's gotta be from you based on your personality. Here it says, what's wrong with holding the SOXL, which is the triple semis, when the semis are outperforming to the sky? There's nothing wrong with it until they start underperforming.
Well, we've talked about this before with the triples. The triples are rebalanced every day. There's a lot of derivatives in this. So if this is, I don't know, I don't think it's a triple of the SMH, but it's of the Philadelphia. But let's just use this.
Same thing. It's
the same thing. The SMH, this is the true ET. Let me do it. Let me show you better with something I know. So the Qs, for example, you can see the Qs old high here before the coronavirus in February, late February. And now you see the Qs was 237. Now you see it at 261 where it closed today. The triple Qs if you look at the 3 times, you can see 118.80, and now it's still closed today at 113. So this is a 3 times the Qs, and you can see while the Qs are much, much higher than that February level, this is lower because with the triples, they tend to be they're good for short-term trading, 1-2 days, but when you hold them longer term, they actually erode relative to the main ETF that follows.
And
So
they erode a lot quicker when we have those quick sell-offs. In the
yes.
trending market, they're fine, but when you get those sell-offs like we had in March, that's when the problem comes in.
Yeah, so you look at something like so it is 3 times the Philadelphia SOXX on MarketSmith. So this is the SOXX. This is the Philadelphia SOX Semiconductor Index. You can see 270 here, and it's obviously much higher at 291. When you punch in the SOXL, which is 3 times of this, look where it is compared to this 328, and it's sitting at 2. I mean, this isn't even like not even anywhere close. It's like a 50% discount. So the question is, what's wrong with it? Is you're better off trading the single one. If you're going to use a triple, be very, very careful only for short-term trades, in my view, because it's an eroding asset.
Right. So single long term, triple short term.
I mean, that's just a general guideline for a novice investor or trader that's just starting out. Stay away from the triples.
Joe, give us some stocks. What are you looking at
Give us
nowadays?
some stocks. I tweeted out Zillow. I full disclosure, I have a position. I like this. They got earnings coming up next week. I love a lot of semis. I tweeted out some charts. Skyworks.
What do you like about Zillow? I think Redfin reported today, no?
Did they? Let me see if Redfin did. Let me see if they might have reported. Yeah. It looks like it's down a little after hours based on this, but the prices could be off. I like Zillow brought back their old CEO. There's a lot of call buying for January of 2021 and 2022, and the open interest anywhere, I think, from the 65 to 75 strikes. And they brought back the new CEO, and the revenues are very, very strong. Sorry, they brought back the old CEO to kind of mix things up, and they're getting into some home buying and flipping. That's why it's highly shorted, because people are doubting it. But I like the story, and I like the growth, and it closed at a new high today. It was nice to see that.
Right, and the housing market is extremely hot. That's unbelievable.
Well, I mean, everyone's moving out of big cities, so someone said Zillow makes sense because everyone's selling their homes. It works both ways. Not only are people, for example, in our little East Coast world, New York City, people are moving to New Jersey, Long Island, Westchester, Philly. People are moving anywhere around to get out of the city, and it works in all these big cities. But not only are people selling their homes, but people are looking to get out of the cities to buy homes. And the existing home sales latest report was off the charts. It was the shortest amount of time in the history of the report that it took a turnover. I think it was like 16 days or something, that existing homes on the markets were just flying. That's why the home builders are doing well, because there's a demand for new homes to be built. So I think overall the housing market's strong, and Zillow is one of the ways to play it.
What else do you have?
I mean, I mentioned I like some of these semiconductors are very, very strong. NVIDIA is the leader. It's hard to tell someone to enter it here, but Skyworks, I talked about this sort of a nice base, sort of a cup with a high handle here, and that broke out today. They're one of Apple's main suppliers, so it's up even more after hours because of Apple's numbers. But semis are very, very strong. Semis are very, very strong. That's why rather than picking one, there's about 20 I could mention. SMH is a nice way to play them. I wish there was SMH minus Intel. I probably just offended some people. But
that's a new ETF.
SMH minus Intel. I know everyone's like, I love my Intel, but I don't know, they're just behind. They haven't kept up with AMD and NVIDIA as far as new technologies. But anyways, you want to take your screen? You got some stocks? What are you looking at?
Actually, Joe, I don't have anything, but let me just give me a second here. Here, share screen. Yes.
Yeah, go ahead. I'll look at some questions here while you're pulling up your screen. Someone said Apple 4 for 1 now can afford to buy a few shares. Yeah, it's nice. They don't really share. They don't really split stocks anymore.
Yeah, it's pretty.
Someone in the chat here, a lot of Peter Schiffs are going crazy over gold, and Bitcoin's being talked about everywhere online because of the dollar. Do you guys spend any time on the precious metals or Bitcoin stocks?
Well, we don't have any Bitcoin stocks actually moving anymore. More, I mean,
You mean
Overstock.
all the blockchains? I haven't noticed. Yeah.
Right. I mean, Overstock is back to
Can you
$76 a
can you
share.
believe this was under $3 in March?
It's amazing. I have no idea why it's up. It can't be Bitcoin because Bitcoin is not up that.
No, it must just be same thing. E-commerce, people buying stuff online.
Yeah, as far as
Um,
gold is concerned, look, I don't look. With all due respect, I don't know what's worse, like the perma bears or the gold bulls.
aren't they the same?
Oh, yeah, they're right. They are probably the same.
A lot of them are the same. I mean, if you're bearish, you love gold. I haven't met a bear that doesn't love gold. But you're right. They're very. The whole point with this is be open minded. I mean, I'm not against gold. I'm not against being bearish at times when but just you can't be perma anything because the market fluctuates. Like Peter Lynch says, the last 100 years, whatever, 30, 40 bear markets and bull markets. There's going to be times when we're in a bull market. There's going to be times when we're in a bear market or corrections. You just have to learn to identify those times and don't be perma anything. You're better off being, I'm perma flexible. That's what I am. You know, you have to be flexible all the time. You got to be willing to change, and when things are lining up, be constructive, and when there's warning signs, be defensive.
You know, the action in the SPAC names have cooled off, because in a very big way over the last couple of weeks.
Yeah. That's to your point about a little bit of speculation. Someone's asking about FireEye. You want to pull that one up?
FireEye just reported that numbers of stock gapped up.
Oh, I didn't even see that one.
Yeah.
Internet security is hot. I don't care what it is.
I mean, this stock was supposed to be hot. It's been a buyout rumor stock for a very long time. If you look at the weekly chart here, it's been going sideways for a while. Roughly $10 to whatever this is over here at 19. Something like this, you got, this is a big bar and heavy volume, roughly 32 million shares. Let it set up, and eventually it's going to set up and give you a good, risk reward trade.
Yeah, I mean, internet security is hot. I just feel like when you pulled up that weekly of FireEye, I feel like you're right. It's been rumored buyout, but it's just been dead money for a long, long time. I think there's better opportunities, but the sector's very, very hot. Is Nugget a good? You know the gold stuff better than I do. Is Nugget a good gold ETF for the long term?
No, Nugget is a two-time ETF.
That's 3 times, right? Or
No,
two?
it was three times, and then once March came around, we had the big sell-off. They changed it to two times because they couldn't keep up. Right, so it's
I
two.
didn't even know that.
Yes, they
That's
changed it.
hilarious. I didn't
They
even know
changed
that.
it. You see here 2x shares. So I mean, look, here's Nugget, right? Here's GDX at highs. So GDX is pretty much, look at this. This is like a 5-year high,
Yeah.
and Nugget is all the way down here.
That's the point we just talked about with the triples. Yeah, no. So yeah, it is 2 times. I didn't even know it was two. Yeah, it says 2x now. Stay away from these 2-3 times stuff. I don't even care if you're not a new trader. If you're I've been doing this 21 years. I'm not a fan of them either. So maybe a short-term trade, but no, as far as a long-term hold, doesn't make sense.
Yeah, and the problem is you got to be, again, let's just talk about long-term holds. What that normally means is if it goes down, I don't want to sell it, so I'm going to have to hold it for the long term. That's what that normally means. so, so long term, if you want to go long term, go with the singles. Go with the single.
Yep.
Or if you want to get exotic, go buy some leaps on the single.
Yeah. Yeah, you could buy 1 or 2 leaps going out, and yeah, that'd be for a small portion of your portfolio. TSM, someone's asked about Taiwan Semiconductor.
Look at this. This is unreal.
That showed up on my screens. I didn't take it, and it just broke out nicely. I mean, that and AMD around the same time took off. But the whole key is my instinct is and Frank's very disciplined with this as well. As far as you're probably more disciplined with this than I am, but specific entries with just really getting a strong entry point. The entry points are as it emerges out of a base. You don't want to buy something when it's stretching straight up in the air because an elastic band can keep stretching, but eventually it's going to snap back in your
Right.
face.
And here's the base right over here where the stock went sideways for roughly 1.7 years. Do you
Wow.
have a screen on your Marcus Smith that tracks stocks that have been going sideways for a while?
Uh, there might be a way to construct one, but I can't think of one off the top of my head. I know
Right.
with a lot of screens, you can come up with whatever you want. Yeah.
Right. So if you guys have, for example, if you have TC 2000, you can create that by just going to an easy scan and doing price growth. And you can do something that hasn't moved more than 10 to 15% here. Price growth in the last 2 years, under 10%.
Oh, wow. That's cool.
Okay. So this is something, all right. So this is one that I already use. I'll change this over here. It'll give you a scan. It'll give you, this is a lot of names, 1836. But let's do
Yeah, I was
this.
going to say, what other parameters do you put in there? Like, do you put above a certain price or above
Well,
volume or?
let's see if we can do some capitalization, let's go with high price stocks to see if we can find something. Oh, all right. So BKNG.
Oh, the old price line. But that's a 10% range or for how
That is
long?
so less than 10% in the last 2 years. So this is 2018 right over here.
Oh, I see what the screen is. Okay.
So it hasn't moved more than 10%. So what you want to look for is you want to look for a base.
A nice, yeah, nice.
Like look, ISRG. This is
Yeah, that went nowhere for a while.
okay. REGN, BlackRock, Netflix. Here's a Netflix before this little nice breakout.
Yeah.
So that's something that if you guys can do if you have TC 2000. So you might want to find something that's just getting started. And I will recommend going with the high price stocks or with the stocks that have the high market cap names. So you can try to rise something that's, in the large cap arena. Or I can do this, Joe. I can do here, the Russell 1000. And now we have 552 names. Wow, 552 names that are down less than that are up less than 10% in the last 2 years. That's pretty amazing.
A lot of names.
That's a lot of names. But you can.
By the way, I didn't mean to interrupt. For people who are on board, send questions, to the chat or through, the chat on YouTube or whatever. Or please send them over so we can make this a little more interactive, so we can take your questions. Please send them.
Yeah. Well, also I'm going to go watch the NBA. Hold on. A lot of Peter Schiffs are going crazy over gold and Bitcoin.
That's the question I just asked. Yeah, gold and Bitcoin. Yeah. Someone has asked about team. Same kind of guidance, but short on EPS.
Right, and that's the reason why team is down. The aftermarket is 174. That's the reason what matters is the price action, right? Because you can have the same thing, but the price action is what determines whether what the big money is doing and what they believe. So not every single report is going to react the same.
I do see that they were doing 30 on Market Smith, like 37, 36% revenue growth, and they had a downtick in revenues and a little bit of a downtick in earnings. I mean, they're doing 40% earnings down to 25. That might be a reason why it's down. It's still a great growth company, but slowing a little. But I didn't look at the report. That's just my first instinct from looking at the numbers.
Right.
Someone else is about, a couple people asked about Bill, BILL. What do you think about Bill, and what makes Bill climb so much higher? I never understand. I'd say more buyers and sellers, right? To be a wise ass. I've seen Bill. I haven't traded this one. I don't know much about the company. Cloud-based software company, automates back office financial operations. I mean, it was really hot off of the IPO, and I have not traded. It's been a very loose range, but I agree it's been very, very strong. But I don't know enough about this company, to be honest. Have you traded this one at all?
I just bought it the other day, but these are trades. I bought it the other day here on 7/7 long at 82.46, down 5 days in a row through the previous day high. These are trades.
All right. So I like your question with your product. When you ask me, What are some of the common questions I get? There's two that I thought of. One is position size, but before I get into the second one, I wanted to fire that question back at you. What, you have a lot of members in your StockTwits room and so forth, and you get a lot of questions. What are you finding to be some of the top 2 or 3 questions?
Well, number one, I think people need to realize that you're going to lose half the time. You need to accept that right off the bat. And the fact of the matter is, you don't need to be right every single time to make money. I think once you learn to accept that you're going to be wrong half the time, that's half the battle. And, people always say, for example, that you learn more from your losing trades. I guess so. But the number one lesson that you learn from your losing trades is that it actually happens, that you're actually going to lose money.
So you're finding people, I don't know what the right word is, are having trouble accepting or comprehending that they're actually going to lose?
Yes. And I think that just goes across, to a lot of people, because again, that's something that we're not, the way we're brought up, we need to be right on everything. That's just the way it is. So it's something, so when you get in the stock business, you have to learn how to lose. You just have to learn how to lose. And this is a great site here, by the way. This is an equity curve simulator, right? And I'm going to do something here. I'm going to put a win rate of 50%. I am going to do a win-loss ratio. Let's do 1.5. That means you're making $1.50 for every dollar that you're making. And then here, we're going to do 1,000 trades, right? And we're going to let's risk 0.25% per trade. This is the way your equity line might look after 1,000 trades. This is what if you're wrong half the time.
That looks like my weight during COVID.
Right. Right. So the
That's
point
like
is
my cholesterol during this lockdown.
The point is that you don't have to be right this is a 50% win ratio. But the key here is, number one, you're risking the same amount of money per trade, and you're thinking not about the next trade. You're thinking about the next 1,000 trades. Because in order for you, if you have an edge in the market, your goal is very simply to put trades on as much as possible so you can take advantage of that edge. And that's what a casino does. Yeah. A casino's not thinking about this blackjack hand. They're thinking about the next 1,000 hands.
Yeah, it's a great analogy.
So the number one thing is that I've noticed is that people have to learn how to take losses. Number one. Number two, they need to realize that the market has no idea who they are. Don't take the price action of any stock personally. The information that comes out of the market is neutral information because it doesn't know who you are. So you put on the trade, you have a plan before you put on that trade, and you execute that trade. A lot of people ask me, hey, Frank, how well can I do in your room? My answer is, how well can you execute? If you can execute correctly, then it doesn't matter. I can give you stocks that'll go up 70%. If you can execute correctly, then that won't matter. And executing means putting the order in, the buy stops, taking your taking your losses at the right time, putting the buy stop in after you had 10 losses, and continuing to do the same thing over and over again.
Okay, here's a great question for you. What do you do to help control your emotions when market volatility increases?
Then the first thing you do is reduce size.
Yeah, that's the first thing I would say.
Just reduce size. That's, you got to get down. Look, the market changes, right? And if for some reason you are not in tune with the market, which is going to happen, we can have a market that's going straight up, but for some reason you're trafficking in the wrong stocks, or maybe you're not in tune, that's going to happen. And the first thing you do is just reduce size. That's number one. Do not trade your P&L. Don't look at your profit and loss. Don't look at your account value every single day. You put on the trades. You keep track of your trades. You get a lot of stop outs. You reduce size. Get smaller. Once you get a couple of winners, then you start to increase your size.
Yeah, that's a great point. And that leads to that why position size is such a common question, because if you own one share of Amazon, you're not going to look at it. If you own 1,000 shares, you're going to be watching it tick by tick. And you tell someone to reduce their position. I'm just picking Amazon off the top of my head, but you know, and you tell someone, okay, reduce your size, and they say, what if it goes up? I want to make money. So it's probably one of the hardest things to do as a trader or as an investor is what is the proper position size so that if it goes up, I just picked Amazon, XYZ stock doubles, that what's the right size that it's going to move the needle enough for you? Because if it's, you know, if you're in a mutual fund with 237 positions, one of those stocks doubles, it's not going to make a difference to the whole fund, you know, but if you are in 10 stocks and one of them doubles, it's going to make a big difference. So that is, to me, one of the hardest questions that I still struggle with is what's the proper position that A, if it doubles or if it goes up, you're going to make money off of it, or B, if it is going to increase volatility or correct, that you can still sleep at night and deal with a normal correction.
Right, right, which is very tough. My recommendation is always you diversify your sales, which means you put on a position like Amazon, and maybe if you have 100 shares, 20, that you're going to hold on until it breaks the 50-day. You're going to hold on to 20 until it breaks the 200, and the other 60, that's for short-term trading. I mean,
Yeah.
that's the, that's, you want to diversify your sell orders, because again, they're two different type of exits or entries, right? You can have an entry where you're using a very tight stop, which is great because you're using a tight stop. If you buy it correctly, you can risk a little bit more and you get a bigger bang for your buck. And then you have the random entry where you're buying randomly, but you're using a wider stop. And what that wider stop does, it allows the stock to go back and forth and it won't stop you out within the noise.
Yeah.
And that's just a much wider stop, maybe a 15 to 20%. And that's what I recommend for most people is to use that wider stop. The problem is that once you get that 20% sell off, they don't want to kick it. They don't want to sell it. They want to hold on. And sometimes it works out and sometimes it keeps going lower. And that's where they get stuck.
Yeah, you make a great point about, having, like, I remember we did one of these and you said even have a 20% stop and someone's like, oh, heavens, 20% is so much. Not if you have a small position. If you got a 2% position and it drops 20% and it affects you 40 basis points, you're risking 0.4%. That shouldn't be, in other words, it's okay to have a wider stop, but you have to have a smaller position.
A smaller position, right?
To deal with that.
Right, because you can risk $1,000 on a 20% stop, and you can risk 1,000 on a 2% stop. It's still $1,000.
Correct.
Well, your position size is going to be a little bit different. How do you control risk when approaching earnings?
So it's funny. That's a great segue because when you ask me some of the common questions I get, one is definitely position size, and another is how do you handle, not just control risk, but holding something over earnings. And that's such a difficult question to answer because, and I'll try to answer it, but I know some people that want to hold something for 6 months, a year, or longer. So that doesn't apply to them. Okay. They're by default, if you hold something 6 months, a year, or whatever, you're going to hold through 2, 3, 4, 5 earnings periods. So that doesn't matter to them because they're playing out a bigger move. Obviously, this person's asking about a trader, and it really is going to depend on the flavor of the market. If we're in a really good market where, a lot of earnings are being forgiven, it's also more importantly going to depend on if the stock runs up into the earnings. Then you probably want to, there's that whole buy the rumor, sell the news. And I didn't understand this when I was a beginner trader. So I'm not making fun of beginner traders because a lot of beginner traders don't understand this. They say XYZ company just killed their earnings. Why is it down? And you see, well, the stock just ran from 50 to 60, made a 20% move ahead of the earnings. That's where buy the rumor, sell the news in anticipation of strong earnings ran up. The earnings come out and, people don't get it. So if you do have a cushion, you can hold over earnings, or if you have a run up ahead of earnings, maybe you can take some off and lock in some profit without the risk.
Right.
Another thing with earnings too is maybe look at the expected range. And if you are going to hold, let's say just the, worst case, or I shouldn't say worst case, but a bad scenario would be down 20% over earnings. Hold a position that if it dropped 20%, you'd be okay with. Like I said, a 2% position on a round number, $100,000 portfolio, you got a 2% position. If it drops 20, You might say that's the end of the world. No, that's 40 basis points on a 100,000 portfolio. You would lose $400.
Nothing at all.
Yeah, I mean that's not. And I'm using round numbers on 10,000, on a million. You can adjust it depending on whatever you're trading with. And if you don't want to take the risk, then don't take the risk at all.
Right. $400.
Let's see. Someone asked me about Fastly. I did lock in some profits on Fastly, and I did get back in with a starter position. So someone asked me about that. Thoughts on Intel, INTC. I mean, we talked about that. I'm not a fan. There's just semis are on fire, and there's just such better companies. They're not executing. They're losing market share in CPU and GPU to, just in everything, data centers and everything. AMD and NVIDIA are kicking their ass. And yes, they pay a dividend, but if you're going to be in this, you're more of a value investor, which means you're probably going to need a long time for this thing to come back, or just to turn around.
On your high conviction long-term investments, do you have stop loss, or do you stay invested even during the drawdowns? In other words, just own it, don't trade it.
Yeah, it's a great question. I mean, Jim Cramer said that about Apple. Don't trade it, just own it. And you could actually insert any of the FANGs, really, if you want, into that. It's just a personal preference. Know your time frame. Are you a trader or you're an investor? I mean, it's if you really like something longer term. I mean, some people have asked me, I'm sure you get this question, give me something for the next 5 years. I can't. I just can't. You're probably just better off in the S&P, because it's really hard. I might like something for the next 3, 6, or 12 months that ends up working for 5 years, but it's going to have monster drawdowns along the way.
Again, and also when you're playing for the long term, you have volatility risk, and that's what you need to be aware of. That even Apple, this is a pretty significant drawdown of 35%. So longer term, holding for the long term, you have volatility risk. You have to be able to withstand the volatility. And we just showed you Facebook and Amazon traded sideways for 2 years. If you're holding a significant amount of your money invested into these stocks, what are you doing for 2 years? Do you have the ability to hold for 2 years while everyone in Robinhood is making a fortune buying Kodak? That's the problem.
It's in hindsight, everyone says, you know what, I just wish I bought Amazon and held it. But how many 80 to 90% corrections did you sit through in Amazon since 2000?
Right. And that's so nowadays you're like, oh, Amazon has done nothing for 2 years, and my friend next door just bought XYZ. I got to sell the Amazon. So
yeah, one of the biggest winners.
Long-term holding.
One of the biggest winners since the 2009 low is Netflix. And Mark Cuban is like, Netflix and Amazon, they said, hey, what's your stop? He's like, I'm never selling it. Now, he's a multi-billionaire. He's a great investor, and he's held it forever. But you know what? He also held it from, some was split adjusted, 300 down to 60 or whatever the numbers are. I mean, that's what he's doing. He's like, I'm holding this, I'm never selling it.
And I think more importantly, it's probably a small part of his net worth that if it goes to zero, it won't make a difference. That's the reason why he's probably so comfortable doing it.
Very good point. Very good point. Yeah. I mean, it's if you are going to say something, I mean, yeah, a lot of it's in hindsight, but you make such a great point. When you pull out those longer term charts, the average hold period was, I don't know what, 7 years. Now it's 7 seconds. Like over the last, 30 years, it's really the average holding period has gone down and down and down. So, information's available. Everyone's looking on their phones and apps and everything and getting quotes all the time. It really does not help contribute to longer term holds with a lot of people.
Here's my idea generation platform right here, robintrack.net.
What is that? What is that site there?
It tells you which stock the Robinhood holders are plowing into.
Oh yeah, so it's whatever's the big percentage gains and point gainers on the day.
Yeah, so TAOP.
I don't even know what that is.
I don't know what that is. 17,000 new Robinhood traders bought this stock today.
Is this your Robinhood screen?
Oh, look, it went from $4 to $14.
Chinese provider of integrated cloud-based platform exchange and big data solutions. That is every buzzword you want. Chinese, cloud, exchange, big data. It's like, why don't they just do a SPAC and do electric vehicles and some plant-based stuff too while they're at it?
All right, let's see if we have any other questions, then we're going to wrap this up.
Yeah,
What are the signs to guess that a company is going to guide higher for the very first time based on your experience?
I found big surprises usually lead to big surprises in both ways. I think when they guide one good quarter, they usually it's like in an early growth stage, and you tend to see a couple of surprises in a row. So it's not a sign that they're going to guide higher. It's usually they already guided higher, and business is very, very strong. Like Zoom's an example where they guided higher, and then like 6 weeks later they crushed their numbers. So when something's in a really strong trend, they tend to guide higher during that, and on the downside too.
Right. So this is right. So I mean, he's looking to guide higher. Right. So here's my recommendation here. So what's going to guide higher? That's just a guess. My recommendation would be to see what stock reacted well to numbers that has done nothing at all for the last couple of years. In other words, a stock that has done nothing at all price wise for a couple of years and then guides higher and it reacts well, then you want to jump on that one. That'll be my recommendation. So that'll be more of a post earnings announcement drift type of play. So look for something that has been neglected for a long time, guide it, stock went up big, then look for an entry. Is there market situations that you would prefer buying support or playing breakouts? Would it be based on market condition, uptrend, or in consolidation, or is it too much of a recency bias?
Um, that's a great question. I think personally, buying breakouts is not what it used to be because everybody knows the levels and the algos know the levels. So it doesn't mean they don't work. It's just it's sometimes too obvious of a spot. So me personally, one thing I've switched over to my arsenal is buying some of the pullbacks and buying some of the consolidations where it's not such an obvious spot. And I know you're a master with that, with what you do. I mean, you can answer that question as well, you know.
What's what I do, Joe? Finding stocks before they break out.
I mean, it's right behind you.
Right. So, right. Look. So, look. A lot of it depends on market environment. In certain market environments, you're going to have breakouts that work out immediately. In other market environments, they don't. That's just the way the market is, right? So we go into these different market environments. My suggestion is that what I do is I keep a rolling, like I have a watch list, a daily watch list every day, and I track them for at least 5 to 6 days, and that tells me how things are working, and that tells me whether breakouts are breaking out the way they're supposed to or they're not. But to me, within my time frame, what matters the most is momentum and mean reversion. So what I have is I have a scans for both. For momentum, which is something, let's just do this. For example, ALT, here's a momentum stock that here in the short term had a mean reversion pattern. Okay. Stock is up from 10 to roughly $30 a share. It's down 1, 2, 3, 4, 5 days in a row. You have a pattern of lower highs and lower lows. Finally breaks that pattern by going through this previous high, and the stock is up 15%, today. So, so my suggestion is if you can find, scans that are going to give you some stocks with momentum and also with a mean reverting pattern, something like this.
Or instead of scanning, they can just hire you.
Joe, I mean, that's exactly right, Joe.
I mean, that's what you do. You find stocks before they break out.
That's what it is. And you can see here, long 2407 down 5 days in a row. Up yesterday through the previous day, high today, and that's right over here. Long today at 7:30.
It's a nice pop there. But yeah, I mean, the point is, I like buying, and we do something just in different flavors. I mix it up. Sometimes I am buying near a breakout, but I'm also looking for some pullbacks on light volume if it's constructive, based on normal price action. And the more you study charts, you'll understand what's normal and what's not. But you do have to mix it up a little bit because you don't want to be buying where everyone's obviously buying.
All right, Joe, let's wrap this up. Where are you on Twitter?
Let me create an account. Yeah. At jfami, joefami.com. If you have any, you can always email me, jfami at Zor Capital. I'll basically go to my website, joefami.com, if you want to contact me or have any questions. And I'm happy to, help out with anyone who has any further questions. Where can they find you, Frank?
Yeah, well, just give me a second, Joe. Here, Mr. Patel. Joe, can you talk about your subscriber service? Do you provide trade setups with stop loss and price targets?
Yeah, I mean, it's a great question. I have a lot of different subscribers with different time frames, so it's a lot of great idea generation and a lot of entries. But the best way to answer that is I encourage people to make their own decisions. Meaning, I have some members who want to hold stuff for several months, so you can't tell them on a $50 stock to take a profit at 52 or 55 because they're looking to go for a bigger move. You also can't tell someone to buy it at 50 to sell it at 80 because they're more of a shorter term swing trader. But to answer it directly, I do provide a lot of great entry points, but I like to leave it up to people, to quote our good friend Brian Shannon, make those ideas your own. They have to make it their own based on their own time frame and make those decisions on their own.
All right, right. But look, we speak throughout the week. But you do midweek market videos and a Sunday video.
Yep. Twice a week videos, Wednesday and Saturday. And I was supposed to do webinars every month, but I'm doing them every week because we're on lockdown. And to be honest with you, I'm enjoying them and I'm getting great feedback. And there's a lot of great members asking questions. And it's basically a lot of education and applying education to the current market.
Right. So you're pretty much just shortening everyone's learning curve. That is the point.
Yeah, I mean, it's 21 years. You've been doing this for a while. Are you still learning stuff today? I am.
Every day.
I'm learning all the time. But you know what? It's overwhelming sometimes. But if you could help speed someone's learning curve up,
right.
That's a huge thing right there.
And you remember years ago when we first started, you had to go to a place, to a firm, and you had to find someone that will actually take his time. Now you can find everyone on the internet. It's amazing.
Yeah. Wow. Where can they find you, Frank?
New York.
Everyone knows you.
Yeah, no, you can find me on Twitter, Zor Trades, and the website, the blog, frankzorrilla.com.
All right, cool. Thanks for doing this, Frank. Appreciate you having me on. A lot of exciting stuff going on in the markets. So I just tell everyone, you know what, keep your head up, keep your confidence going, always learn. I love the point you made, Frank. I'll leave people with this, just accept you're going to be wrong sometimes. We're going to make some mistakes, but do post analysis of your work and keep making that progress. It takes time, but keeping your confidence high is that mental toughness is very important.
Right. Let me answer this last question, Joe, here. I want to know the website name where I can get the information about what percentage a company has beaten EPS and revenues.
Yahoo Finance has that. Under Yahoo Finance, it's free, type in the ticker symbol and click on analysts or analysts, and it'll tell you the earnings estimates, and below will tell you a history of the past 4 quarters with how much they beat their estimates by.
Oh, wow. So you saying Yahoo Finance /analyst?
No, Yahoo Finance, type in the stock symbol, and then it'll be like profile, statistics, holders. There'll be a whole bunch of tabs. You click on, I think it's analysts, and it'll give you the estimates, and below that, the past 4 quarters of what they've done with earnings and revenue history.
And you can also go, if you just want the last quarter, you can go on to earningswhisper.com.
Yes.
They do a very good wrap up also. Punching your email, subscribe. They do a very good wrap up. And they tell you how much they beat by, what was the whispered number. That still exists, by the way, whispered number. That used to be a big deal before.
I know, that was a big deal. You're right.
So that's another great site. So yeah, look, I just learned Yahoo Finance. Oh my, learn something new.
Yeah, the Yahoo Finance, when you dig in, there's a lot of stuff in there, and it's a great thing. Someone's saying thank you for sharing wisdom and knowledge. Thank you guys for tuning in, and we got 12 likes and 1 dislike. Not bad.
Not bad. All right, guys.
Hey everyone, thanks for tuning in. Good luck tomorrow, and reach out to us if you ever need anything.
Thank you.